Javad, and here is it's our today's first class on finances. In this class, we will study what are the finances, their definition, types according to the finance taker, and time span, and other comprehensive conceptual discussion on them. So before we can start our class, kindly subscribe my channel so you will receive my videos on a timely basis. So let's start our the class. What are finances? Finances are the cash, funds, or resources required to start a business or to smoothly run existing business operations. It means the cash or the funds or the resources you require to run a business or to start a business from a very initial point. So firstly, I'm also writing the business definition of finances. What is the conceptual definition that is being used in different standards of finances? So firstly, I write the definition and then we'll try to explain it briefly. So firstly, I am writing the definition as per the different standards. Finance, finances are the money management and process of acquiring them when needed. It also encompasses oversight, creation, and study of money, banking, created credit, investments, assets, and liabilities that make up a financial system. So we can recall the definition that is finances are the money management. It is merely the management of funds or money that a business already have or it's needed to make the business run smoothly. And it also involves the process of acquisition of new funds or resources when a business needed them badly. It also includes oversights. Sometimes the business oversight its need due to some problems. Then finance management can handle this problem of oversight, creation of finance, study of money, banking system, credit system, investments, assets, liabilities that make up a complete financial system. So, merely a finance is the cash, funds, or resources that are required by a business to run an existing operations smoothly or to start a new business or to expand the current operations or to enter into a new financial market to increase the business up to the demands of our customer or to expand our profit margins. The concept of finance originates or starts from the study of two sectors of economy that are first one is macroeconomics and the second one is microeconomics. Macroeconomics deals with the macro aspects of an economy regarding government, creation of funds, taxes, and other problems that are mainly concerned with the government initiatives or government concerns. They involve major problems like inflation, deflation, unemployment level in the economy, and other related aspects. And microeconomics deal with the micro aspects of the economy. It is merely concerned with the consumer needs, its demands, supplies, and market equilibrium related problems that are mainly concerned with a single individual. So these are the two sectors of the economy where the problem of finance arises. They mainly focuses on the concept of time value of money. This concept states that the existing resources are more valuable than the future ones due to many reasons. One of the reasons may be the inflation or devaluation of the currency. So, the problem of finance or the study of finance start with micro and macro economic issues that mainly focuses on the problem of time value of money, which states that the existing resources are more valuable than the future one. The value of existing dollar is more fruitful for our business than the value the dollar will obtain in the future. For example, for example, if you have $100 right now, these are more valuable than the $100 we have in the next year, as they involve inflation, in which the current value of the money goes down, or the other issue may be other social economic aspects, socio-economic aspects. So, what we have studied right now, what is the definition of finance? Finance, the definition is it is the resources or the funds that a business merely required to start its business operation or to enter into a new market or to run smoothly the existing operations of a business. The problem of finance initially starts from two economic aspects that are macroeconomic and microeconomics that what focuses on the concept of time value of money, which says that the existing resources are more fruitable for a business than the resources it will obtain in the future. So let's move on our study. Now we study or discuss what are the types of finances. There are three types of finances. First one is personal finance. The second one is corporate finance. Third one is public finance. Now we discuss each one of them briefly. So let's move on the next slide. First one is personal finance. Personal finance merely relates with a single person. He will formulate different strategies to get finance, keeping in mind different personal aspects like his livelihood, means his is earning. Second aspect he will consider will be the living standard. He is trying to achieve or the existing living standard he is living in with. His financial need, how much his need is big. Its objective may be to fulfill the future needs of future event fundraising, or the most important one is his personal desires to reach a certain level in his life. So So, personal finance relate to a single person and his process of formulating different strategies to get finance, keeping in mind its livelihood, means its earning, existing living standard, or the standard you want to obtain is in his life, his financial need, and the most common one, that is personal desires that need to be satisfied. So he will contact different banks or different financial institutions to take funds or money to regulate or to justify his thinkings or his financial needs. So let's move to the second type, that is corporate finance. Corporate finance deals with the funds required by a business entity to start a new project or to strengthen existing operations. They will contact they will contact different financial and non-financial institutions either to take loans or from the capital market, that we will study in our next portion of the video, or issue new shares. The third type of finance is public finance. Public finance means funds required by the government and its institutions to finance their projects, keeping in mind public welfare concerns. It mainly focuses on government receipts and the payments government are making against them. Government receipts mainly from taxes, taxes, levies of tax, withholding taxes, and other funds. Government mainly utilize these funds on general public welfare areas like building a hospital, schools for children, and other financial markets where the general public can invest their funds or withdraw them as per their need and the time of importance. So these are the three different type of finances. So let's study type of finances as per the time span or time period. So what are the different types of finance on the basis of time period? First one is the first one is long-term finances. Second one is short-term finances. So let's start to learn both of them. Firstly, we start from the long-term finances, what they are. Long-term finances are usually the finances that involve a time period of more than a year. So long-term finances are those finances that involve a time period of more than 1 year. And what are they? Are firstly are the share capital. Second type of long-term finance that a company can pool or can get funds from it is through taking loan from the general public and issuing them debenture certificates. Third one is the most easiest one, the bank loans, on which the bank charges interest. So a company can raise its finance in a long run business by issuing its share capital, means issuing shares to public on which it need to give dividend. Second type of long-term finance is debentures. Through issuing debenture certificates, a company can get loan from general public and on which company need to pay interest on them. So the borrowing cost in the case of share capital will be the dividend, and in case of debentures is the interest. Same applies to a bank loan. A company can raise its finances through taking loans from different banks. They involve both commercial banks or public banks, on which company has to pay interest, which are borrowing costs for the company. So these are the long-term finances. Now study the short-term finances. As we already study, short-term finances involve only a period of less than a year. So all type of finances that involve or comprises on a period of less than a year are called short-term finances. And what are they? The first type of short-term finances are overdraft. What they are? Overdrafts are the excess payments that a company can take from a bank against its existing funds. A bank usually charge interest on it. So what is? I can briefly write here. Excess withdrawals as compared to funds available in a bank. The bank usually gives this opportunity or facility to its long-term customers and normally charges interest on it. Every bank has its own rate of interest. Next one is short-term loans. They can be taken from any financial or non-financial markets, and on which you have to give interest on a yearly or biannually basis. The third type is bill of exchange, promissory note, and other negotiable instruments. So there are three types of short-term finances. First one is bank overdraft, second one is short-term loan, and the third and the last one is bill of exchange, promissory note, and other negotiable instrument that can easily be transferable in the name of another person. All required. So now come, what are the sources of business finances? Means where you can get this finances. I think the video is getting longer, so I am dividing this class into two equal parts. So we'll discuss this topic in our next class. So let's meet in the next class. Thank you for your time.